Yep. Thank you, Your Excellency. Your Excellency Raila Amolo Odinga, Your Excellency Martha Karua, party leaders, honorable members of Parliament for the state, ladies and gentlemen. But I think we should have applauded the Honorable Odinga for a fantastic speech. Thank you. So my colleagues and I will simply point you to, if you will, specific clauses, because the Honorable Raila Odinga has already given to you the broad strokes and highlights of what is going on. So we'll just go into it, and we'll share the presentation with my colleagues. And at the very end, there will be an opportunity for members of the Fourth Estate to ask questions. Now, well, look, I know some other commentators will say, how do you finance, development that you do have to tax? It is true. I mean, budget is an expenditure, and then you finance it through taxation measures and through borrowing. The difficulty, of course, is that if you tax your economy beyond what is practical, then actually it collapses. If you borrow beyond what your means or what you should borrow, your economy similarly collapses. So we'll just take you clause by clause on what these taxation measures are, and explain briefly what the impact of each is. As you've all know, the bill is or looks at 5 broad areas: income tax, withholding tax, value-added tax, excise duties, and miscellaneous fees and levies. Now, it's important to remember that income tax is supposed to be a tax on income, and we'll come back to this point briefly. So let me start with turnover tax. So clauses 9, clause 24B propose to increase turnover tax from 1 to 3%, and also bring down the threshold from which you start to pay. And the threshold comes down to 1,370 shillings. Basically, if you have a kiosk around the corner selling tea and mandazi, if you sell 1,370 shillings per day, then you pay 3% of that. You can also think about it. I know many of people in the city take a taxi, like Uber or Bolt or Ruto'S or whatever. This is 2 taxi rides. If you take a taxi from here to there for 500 shillings on his return or her return journey, then she'll probably already begin to pay tax. The point about turnover tax is that you are taxing the top line. You are taxing somebody whether they make a profit or not. And really, we should be looking at taxing income, not overall revenue. Clause 5 of the bill proposes to tax employee share ownership programs. If you have a small business and you want your staff to get committed to the business, and you offer them some few shares, and this is a common practice with Kenyan small businesses, so that motivated to work even harder. Now, this will attract 30% because it's considered part of your compensation. Remember, ladies and gentlemen, that dividends are already themselves taxed in addition to capital gains. So this will end up being a triple taxation. And you will see in the bill that the valuation, determining what is the value of these shares that this small business has provided to the employees, is up. The determination is up to the commissioner, which therefore leaves room for abuse. The bill also proposes to tax at clause 24 to increase the rate of tax from 30 to 35% for those who earn 500,000 or more, so-called high earners. In most jurisdictions in the world, corporation tax is either higher or at the same level as personal tax. So it's not in many places where you will find that the employee is taxed at a higher level than the organization that they work for. But this is what is proposed at clause 24, moving from 30 to 35%. Clause 5 targets per diems for public officers. So per diems, travel allowance, mileage will now be taxed at 30%. Now, what we want to point out here, per diem is not an income. You pay or you provide it to an employee so that they might go to Mombasa or to Kisumu or Nyandarua or Machakos for work. So you cannot treat it as though it's an income and then tax it. We are quite certain this is going to affect motivation and morale and disadvantages public sector workers a great deal. I want to talk briefly about withholding tax. Now, the current level of withholding tax for professionals, if you are an architect, an engineer, a consultant in economics and so on, is 5%. So that when, as a professional, when you work for an organization or an individual and they are paying you, they withhold 5% and remit it to the tax authorities. The proposal is to tax content creators at 15%, and you will see this in clause 2 of the bill. Now, this is, of course, quite discriminatory. Now, and you have to remember who are content creators. They're most likely young people using ICT, and the proposal is to tax them or to withhold at 15% as compared to 5% for everybody else. So it's quite discriminative, and we think it's going to discourage instead of encouraging the digital economy, and obviously has a negative impact on young people. Clause 10 and Clause 24 propose to tax digital assets. Digital assets, cryptocurrency or non-fungible tokens. But let's talk about cryptocurrency like bitcoins. And the way you can think about it is the same way you think about dollars or euros. You have businesses that are called forex bureaus that buy and trade currency. You don't tax them or for the volume that they have sold. Instead, you check whether they have made a profit and you tax the profit. What is being proposed at clause 10 is to tax the bitcoins at 3%. So you are taxing the person whether they have made a loss or not, which we should not be doing. I think, well, maybe I shouldn't say that, but I suspect some people, yourselves here for the state in communications, perhaps you moonlight in DJing services and so on. So you will not escape if this bill passes. Clause 24 proposes to tax promotional services at 5%. So, for instance, if you went to an event like this and you are, providing the service of being the master of ceremony, and then you're paid some little token, then that token is going to be charged at 5% withholding tax, and you will find this at clause 24 of this bill. The advance tax at clause 24, and the proposal, of course, is to increase this advance tax on saloon vehicles, on buses and minivans and trucks and so on. And the Prime Minister has walked you through this. The impact, of course, is what we are explaining. If this proposal passes, a normal truck will now be paying 60,000 instead of 20,000, and this obviously is going to affect all goods because all goods are based on transportation services. Reflect on again the people who do who offer taxi rides on various ride-hailing services. Those vehicles that are then used for this purpose they will be now paying 5,000, which is about double what they are paying now. And I want to encourage my colleague, the Honorable Bandi, to come up and help me with the balance of this presentation. And as I said at the end of the presentation, we will welcome Q&A. Now, Clause 17 redefines, please come. Clause 17 redefines entities, including social welfare organizations, chamas, clubs, and so on. And what the clause is trying to say is anything you get beyond subscriptions will be considered business income. So now in your own, and as the Prime Minister has explained, around the country, in every village, women, men, young people organize themselves in chamas and merry-go-rounds. And the effect of this clause is to consider whatever proceeds they receive as income. Anything above subscription. And therefore subject to taxation at the normal 30%, which is the rate of income tax. You can see that this is obviously going to discourage savings amongst women, amongst youth groups, amongst anybody really who is in this circumstance. The last one, so that I invite Honorable Badi, is capital gains tax. Clause 26 proposes to introduce, in fact, not enhance, capital gains tax based on property if you put that property in a business. So when two partners get together and they start a business and you put your assets into that business, obviously the balance sheet of that business goes up. The value inside that business goes up. And the proposal at clause 26 is to tax it, to tax that incremental. I can see Professor Naituli is looking at me. Let me re-explain. What I'm saying, Professor, is like this. If Professor and Mheshimiwa Wajakoya, decide to start a business and you each put an asset in that business, obviously the balance sheet of that new business goes up by the value of the assets you've put in there. The proposal is that if that value is more than 20%, it should be taxed, which I can see the Honorable Kioni is looking at me. These are not my proposals, Honorable Kioni. This is what is contained in the finance bill at clause 26. So do not throw your cap at Buddy and I. It is a bit outlandish. Thank you, ladies and gentlemen. I want to invite my colleague, Honorable Bandi. Please proceed. You'll use that one.
Thank you very much, Your Excellencies. You know, at times, I know when